Hi, I'm Greg Hunter. Welcome to USAWatchdog.com for this special audio version of USA Watchdog. With us today, a brand new guest, a guy I've been following and am a fan of, and a fan of his work, David Stockman. David Stockman, of course, is the former White House budget director in the Reagan administration, also a former congressman, has a deep resume on investing in Wall Street. He's out with the new book called The Great Deformation, The Corruption of Capitalism in America. David Stockman, thank you for joining us today on USAWatchdog.com.
Very happy to be with you.
Well, I wanted to start because I've seen a bunch of interviews with you, and every time you are on, at least mainstream media, they always look at you with some, amazing astonishment that anything ever bad could happen in America. One of the guys is Neil Cavuto, who, not this last interview, but one of the interviews, at the end of it said, okay, great, now we can stick a needle in your eye. And you remember that? I thought, what? Yeah. I actually posted that interview, but they cut that comment off on Fox. But anyway, the long and short of it is, what is your your reaction to when you go on these mainstream media interviews and they act as if you don't know what you're talking about, nothing ever could be bad happening to America. What's your reaction to that? What's your take?
Well, it doesn't surprise me because much of the mainstream media is totally caught up inside the bubble. They have an extreme case of what I call recency bias. In other words, what is moving the market today, what's in the headlines, what was the news yesterday. They can't even remember the events of a few years ago or of earlier this century. So I've been saying lately that look at this bubble inflating all around us. I've used as an example just to shake people up the Russell 2000, which is really the small cap index, 2,000 companies, mostly domestic, mostly Main Street, mostly, small companies, is now up 43% in the last year, 230% in the last 4 years from the bottom, and is trading at 75 times reported earnings. Now, people, seem to forget that's exactly where we were in 2007, 2008, when the last bubble was inflating. No one saw it then. And they forgot then that the same syndrome was appearing in different aspects of the financial market, different classes of risk assets, so-called, in late 99 and 2000, when the first bubble, exploded all over the place with the dot-com crash in 2000. So, somehow all of this gets lost. Somehow history is thought to be not repeated, but simply a new adventure every day. And I think one of the things that I try to do is say that when the fundamentals are fundamentally out of alignment, when you have a Fed doing what it's doing today, when you're running the kind of deficits that we are today, when you have the kind of crony capitalist corruption of the medical care market or the financial markets or the energy markets that you have today, then you're not in a healthy, free enterprise, growing capitalist economy. You're in a crony capitalist bankrupting mess. And, that is very disconcerting news to people who were inside the bubble, who are drinking the Kool-Aid, so to speak, and who have forgotten even the recent past, to say nothing of the longer-term history and the principles that have been proven over time to be necessary for, healthy economic progress and growth.
Well, the Chinese and the rest of the world everybody thinks that they don't see this, that the rest of the world doesn't see this. Mm-hmm. And the Chinese last week stopped a couple of big stories out of China that I think are monumental. I want to get your take on it about moving the dollar. They stopped stockpiling U.S. dollars, and they stopped pricing oil they started pricing oil in yuan. That right. Is a 1-2 punch for the U.S. dollar, is it not?
Yeah, I think it's a major inflection point, but it's also a reflection of the fact that the disease that I'm talking about, money printing at the Fed, a central bank that's out of control, that's suppressed interest rates to zero, that's distorting the pricing of all, securities in the financial markets. That disease, I call it, the Keynesian monetary disease, has been exported to the entire world. Most of the other major central banks are doing the same thing. The Bank of Japan is even more extreme, as you know. But the point I'm getting to is that the People's Bank of China, which I happen to call the People's Printing Press of China, has been doing the same thing that the Fed has been doing for the last 15 years, and primarily in order to keep its exchange rate down, therefore keep its export machine humming, and its mercantilist trade policy intact. But as it's expanded its monetary system massively, in the process, it was buying up, dollars, investing them in treasuries as a defensive maneuver to play, the global monetary expansion game that was emanating from the Fed. Now, I think they've reached the point where they've got 3.5 trillion of, paper assets, mostly dollar-based, much of it Treasury or GSE debt, that they've accumulated trying to suppress and manipulate their exchange rate. They're sitting on this massive hoard of paper that they're never going to be able to do anything with. In other words, they have sold the goods of their economy for the last 10 or 15 years cheap, their labor cheap, and they've traded it for treasury bonds, and they're beginning to wake up to the fact that this isn't a sustainable policy. They've got huge distortions inside their economy, massive speculation, as bad as anything that we have. Their inflation is a constant problem. And so I think they're beginning to recognize that the Keynesian central bank policy that they have adopted, and adapted to from the West is going to take their economy down unless they change directions. Whether they can or not, I think, is a huge open question, but it's a symptom that this whole global central bank game is nearing its end stage.
Do you think the U.S. will ultimately just flat out, in some way, shape, or form, default on all that debt? You're saying they won't be able to put it to use. Then you must be saying that we're going to default.
No, I'm not saying that we're going to default in the classic sense. This is kind of uncharted waters that we're in. But there is a risk that when the Fed finally has to taper, when they finally have to stop printing $85 billion a month, and just logically they can't do it until eternity, obviously, at some point, and I think fairly soon down the road they will have to stop. The effect of that will be to allow the law of supply and demand to come back into the market for fixed income securities and treasuries. If you had an honest market cleared by supply and demand of savers and borrowers, the treasury rate would be dramatically higher than it is today.
Like what? How high would it be today? How high
Well,
today?
It could be a couple hundred basis points higher. Instead of being 2.7 or whatever it is this morning, historically it would have been 4 or 5%. Now, the reason I think this is important is that when the yield gets back to normal, then the price of all of this paper is going to drop by an equivalent amount, and the Chinese and other people who speculated in the treasury paper are going to face huge losses. And that will then make it much more difficult for the treasury to sell new bonds. And then that will compound the cycle of falling bond prices, rising yields, a crisis at the heart of the financial system, which is the 10 or 12 trillion treasury note and bond market. And that's, when the day of reckoning is going to begin to unfold. And everybody will be caught up in it. There's 2 trillion of this paper sitting on bank balance sheets in America. They're going to have a day of reckoning. There is 5 trillion of this U.S. government paper owned by central banks around the world. they're going to have a day of reckoning. So this is not a viable system. It's a house of cards, and each day they try to find some way to keep it going, but logic tells you that sooner or later the thing will come unwound.
When you say come unwound, you're talking about massive bank failures.
Yeah, I think there will be failure, massive failure on the part of speculators who think that they are, right now speculators have been making a killing, let's say in the 10-year Treasury, by buying it for a yield even of 2.7%, and then posting the bonds as collateral and borrowing 98 cents on the dollar in the so-called repo market. So in the real repo market, which is the short-run overnight market where the Fed has set the rate at 5 basis points, you can borrow money day after day, roll it day after day for 5 basis points, which is 1/20th of 1%. Use that financing to buy the Treasury bond, which has a yield of 270 basis points, collect the spread, laugh all the way to the bank, as long as you feel that Yellen and Bernanke and the rest of the Fed, monetary central planners, as I call them, can keep the market under control. The danger is that when the speculators lose confidence, they will unwind that trade. They will sell the bond, pay back the overnight so-called repo loan, and there'll be a lot of selling, a lot of offers, and very few bids. And that's where the price starts to collapse and the yields start to soar, and then the panic will set in, both in the Eccles building where the Fed is housed, but particularly on Capitol Hill, where they're all dream-walking, thinking, the deficit is a theoretical problem and we'll get to it someday, but right now we can borrow at such cheap rates. Why should we, put ourselves in harm's way with our constituents by making tough choices, cutting spending, or doing other measures to close the deficit gap. So the Fed is basically house-trained Capitol Hill in a very bad way, in the sense that they've created a fiscal manana culture that seems to believe that we can get away with this indefinitely because the cost of carrying the debt has been made so artificially cheap, really absurdly cheap, by these academic zealots who have taken over the control of the Federal Reserve.
Now, when you say that panic is set in, let's get down to the street level. What does that look like to, gas prices, food prices, housing prices? You just came out with a thing about the myth of the housing recovery.
Yeah.
What does this panic that you're talking about look like to the man in the street? And how soon can we have it?
Yeah, well, I think it's an interesting point. One, I think the unwinding will be a deflationary cycle, not inflation. So therefore, I do not think gasoline prices are going to go up. They'll probably go down. I don't think food prices will go up. They'll probably go down. But all financial assets, including housing prices, which are way overvalued because they're being bought by speculators on debt, which is, way too cheap, financial asset prices will collapse. And so this time, the real ground zero will be in the financial community on Wall Street among the speculators. They're the ones that are going to be taken to the woodshed. I don't think it's going to be a good time for Main Street America because there will be a lot of fear and the economy will be grinding away at a low level of performance, but I don't think it's going to be some kind of hyperinflation that is devastating to Main Street. It's going to be a correction that will hit the speculators and the casino, which has become, our financial system has become a casino. The casino is going to get hit by this far harder and more traumatically and violently than will Main Street.
So some of these big trading houses like Goldman Sachs has an unbelievable amount of derivative leverage.
Right.
And J.P. Morgan has a pretty stiff, like a 35 times capital. Goldman Sachs has off the chart derivative to leverage. So could some of these banks go under?
Yeah, I think there is a grave danger, and that's why we've wasted the last 5 years doing nothing about the banks. Dodd-Frank is a total waste of time. It's 2,000 pages of statutory gobbledygook that cannot be implemented, and it's generated hundreds of rulemakings that are totally being corrupted by the lobbying forces, of K Street. So we have basically wasted the time. The banks have now become even more dangerous, and we'll have a day of reckoning. And I hope we don't get the same panic we did last time and bail out Wall Street like we inappropriately did in 2008. We'll just have to see, but I think there is going to be a lot more furniture broken when the bubble finally breaks.
Who do you think would go under? Who do you think would be a target?
I can't make any predictions about that.
But you think some good banks could go under?
Yeah, I think it's very possible unless they find some rationalization to bail them out again. I think anything is possible because the Federal Reserve now has so twisted and manipulated its mandate that it can probably come up with a reason to bail out anybody. So I think the more likely thing you're going to face is the threat of more big bailouts on the grounds of, the whole thing we heard before, systemic risk and financial contagion and all the rest.
And wouldn't that be inflationary if they started putting the money printing into overdrive?
They're putting, the money printing's in overdrive has been, in the year 2000, the balance sheet of the Fed was $500 billion. Today it's pushing $4 trillion. It's up 8x. Now, in a world where there's tremendous excess capacity and cheap labor left, there isn't going to be goods inflation or CPI inflation. Instead, the money stays in, as I say, the canyons of Wall Street, and it causes asset inflation. In other words, the inflation that we saw in the price of goods and labor in 1978, when the first round of massive money printing by the Fed, post 1990, post the opening of China and the rest of the so-called emerging market to the Western world trading system, the dynamic has shifted, and now we get tremendous asset inflation rather than goods inflation. So, therefore, that's the direction that this has gone. When the Fed has to bail out the banks next time, it will be because asset prices are collapsing, and it will maybe keep these institutions semi-solvent while the carnage is being sorted out.
So with basically hyperdeflation, I guess you'd call it.
I guess you could use that word, yeah.
Would you use that word?
Anyway, I would call it severe deflation, yes.
So in severe deflation, how do precious metals work? Do they work, or are
I
they
think
terrible?
they do. Yes, I do. I think initially everything will sell off because there'll be margin calls, and there are a lot of speculators in the gold market, just like every other market. But differently, as the world sees the central banks failing, as they see the assurances that we know what we're doing, that is the Monetary Politburo that runs the Fed, as they see those assurances go up in smoke, I think there will be a flight to a monetary asset that people have some confidence in, and gold will be that asset. It has been for centuries and centuries. So after an initial sell-off, I think there's a very good chance that gold prices would soar once the financial system comes unwound and the central bank-dominated epic that we're in today comes to an end.
And silver prices, I guess, would follow gold?
Yeah, I'm no expert on the silver market, but, there is every reason to believe that it would be considered a second haven in that kind of scenario.
So you're looking at gold and silver like financial insurance for hyper-deflation or severe deflation, destruction of assets?
That would be a good way. Risk assets are all inflated because the core long-term interest rate, the 10-year Treasury, has been artificially manipulated, suppressed, and pushed below economic levels. And, the interest rate on the 10-year is the central rate in the entire financial system of the world. Everything else prices off of that, as you know, on a spread based on risk or exchange rates or inflation differences. Well, as a result of that, most financial assets have been dramatically overvalued because the cap rate is too low, and there will be a very hard landing correction in the value of financial assets, so-called risk assets, and a commensurate flight to the traditional haven of gold.
Would you be selling your stock portfolio now?
Well, I don't really give any financial advice,
Okay.
But what I do say is there is no reason for anybody to be in the stock market today. It is a dangerous, vibrating casino that could tip over violently any day or any hour. So to get the last 2% or 5% or 10%, as they tell you every day on Bubble Vision when all the money managers come on and say, yeah, down the road there's a problem, but stay in the water because it's warm for the next week or month, it's not worth it, because when the correction comes, they happen so fast, so unexpectedly, and so violently that the average guy can't get out of the way.
And I just want to circle back to this one more time. The stockpiling of U.S. dollars the stopping of stockpiling U.S. dollar by China and the pricing of oil in yuan. Is that going to help this crash come faster? And do you think 2014 is the year?
Well, I don't know that will help it. I think it's more of a symptom. In other words, they're talking about pricing oil in RMB, but I don't think it'll really happen. In other words, I think the central bank system of the world is going to fail long before you could get an alternative so-called reserve currency created.
And what about 2014? Is that going to be in the next 2014 or 15? Do you think this panic, this collapse, this calamity, this interest rate spike, do you think it happens in 2014?
Well, we're in uncharted waters. Nothing that you can look at historically will tell you, when the moment of reversal is upon us. You can only look at the fundamentals and see signs all over the place that suggest we're nearing a tipping point. When you get 1.3 trillion of junk bonds and loans issued this year, 4 times more than 2009 when we were beginning to sober up after the last crash. When you look at the speculation and there's a huge IPO bubble all over the place right now, including Twitter that came out at 45 times earnings, or Fannie Mae up 1,200% in the last year because a bunch of speculators have jumped on that insolvent ward of the state. When you see that kind of churning and gambling all over the place, I think it's a sign that we're nearing the tipping point. But what the catalyst will be, no one can really know or even guess. No one would have guessed it was the Lehman event in 2008, and Lehman didn't cause the crash. It was merely the final catalyst, the bell that rang, that caused people to wake up and sell the exposed positions they had. So we'll face that catalytic moment at some point, but it could be next year, the year after, or longer. But I don't think this bubble can keep inflating at this rate much further.
All righty. David Stockman, you, of course, are the author of the book that came out earlier this year, The Great Deformation, The Corruption of Capitalism in America. You're the former White House budget director in the Reagan administration. David Stockman, thank you for joining us today on USAWatchdog.com.
Thank you.